All right. Well, hey, everybody, I want to welcome you. Again, I apologize for the delay. We had a little bit of technical issues. This Randy Lawrence here with Prosperity Capitals. I want to go ahead and I know a number of folks are going to be still continuing to log on. So let me go ahead and share my screen. Let me see here. Yeah, again, let's see. All right. All right, here we go. Now we should be able to see exactly what we have here on our screen. I want to just go through this with you. And again, I appreciate your patience with some of the technical issues that we had. Unfortunately, that does happen. We are definitely masters at apartments, but sometimes technology can be a little bit of a glitch. But so with that being said, let's go ahead and get started. The reason that we're here tonight is we're talking about the property that we have. It's a two-property portfolio, the Carolina and Britton Village there in Atlanta. And so really going to be an exciting thing. It's 150 units in Lawrenceville, which is an amazing submarket of Atlanta. The property itself, looking at the actual breakdown and the combination here, Britton Village, we've got 68 units, 96% occupancy. Built in 1986, and then the Carolina, 82 units, 98% occupancy, built in 1970. And so again, great cash flowing properties, high level of occupancy, even to with this right now, and we'll talk about this a little bit more at length as we dive into this, but we have also an income guarantee through our contract period to closing, and that helps as part of this COVID offset. So again, great opportunity. When we look at the investment opportunity itself, we're looking and tracking for a 16.76% projected return, cash on cash, just under 11%, with a total return of 92%. K1 in investor depreciation for the first year on a $100,000 investment is tracking for $56,000. And we're going to go through that. The timeline on it's about 48,000. The minimum investment is 100,000. The maximum is 1.2 million. These type of opportunities do go fairly quickly. The last one we have, I mean, we don't have these all very often, so to speak. The last one we have was last December with this type of growth opportunity. And in that we had, an investor group that took $1 million of the project. Right now we have a couple of groups, one looking at it for 2 million, another for $1 million. So these tend to go quickly. I know some of you, of course, have invested with us in the past and have already expressed an interest. You can go to pcpre.net/13. That is the sign up page where you can indicate, hey, I'm interested in X amount. And if you have any individual questions, you can also address those at that time. So, but again, we're going to go through all of the information here on the property and really work through this. And once again, I apologize for the delay with the technical issues. Now, if you do have any questions, you can email those throughout the time frame. So again, we're going to hold questions at the end, but as we're going through it, if you have a questions, just email it to questions@pcpre.net. And then towards the end of the presentation, we will go ahead and be taking those questions and answering them, okay? And look forward to it. It's going to be an exciting night. And what I would say is that realistically, we're probably tracking for about 45 minutes and wrapping up 8:30 Eastern Standard Time. So before we dive into the property, let's talk about our team. Looking at my wife, Sarah Jo, and myself, I've got a degree in finance, minor in economics. For 15 years, I was a stockbroker and a registered investment advisor managing $75+ million. Sold our company in 2006. Part of the reasoning of that was I saw the power of what real estate could do compared to the returns that we got using stocks, bonds, options, futures, that kind of thing within a managed portfolio. So 2003, we started our real estate firm and private equity company. Since that time, we have double-digit returns for our investors with no loss of capital over 17 years. That is what I would say is an amazing track record that even goes through the period of 2008, 2009. Extremely proud of that, of how we've been able to transform and impact our investors' lives. Currently, we have over $105 million in property ownership. And then as of the closings here over the next couple of months, that will bring us to, by year end, about $135 million. We are a fully integrated acquisition operations company. We also have a single family home division that flips about 70 houses a year. So our team, if you look here, we've got acquisitions, we have accounting and auditing, myself as the team leader, we have investment administration, underwriting and acquisitions, closing and operations, and construction management. So we do have a very robust team that's working 7 days a week, right? Now working, every day, Monday through Friday, to really further the interest for our investors and to accomplish the outcomes that we're looking to achieve. So it's something that we're working diligently to get the outcome. So what I'd like to do is to dive in and talk about what's going on in the marketplace there in Atlanta. So when we look at the overall combined market and you look at what's going on with current new construction, now again, this particular location is an A grade location. It is a B quality asset. And with respect to the property itself, in looking at this marketplace and the actual locations, under new construction, we've got 4 properties that are underway to be completed. When you look at the 4 and 5 star rated properties, you have a 13% vacancy. You look at the 3-star properties at a 6% and the 2-star at a 2.8%. Now, again, both our properties are tracking right now at 96 and 98% occupancy. The rating on average is at about 6%. But again, also what you see is that this is the perfect timing to be in this type of property. What I mean by that is we're surrounded by other newer class assets. There's a lot of A-class properties in this area, and some of the things, of course, no doubt that they're building are A-class. But as we go into a softening environment like we've experienced because of COVID, there are a lot of people who were paying $1,500, $1,600 a month's rent, and they'd like to be able to be in the same area, but to have a cheaper rent price. And so we're going to address that as we work through this. Taking a look at the actual employment base. Now, again, this is a top area. Gwinnett County, where this is located, is home to 120 international firms. It is the #1 net migration area in Atlanta. So Atlanta is like, it's just exploding. Now, we focused on this area many years ago, but even now with COVID and what's happened in the economy, that's been an acceleration of what's going on, where companies are leaving these, high regulation, high tax states and finding the place where they have business-friendly environment, low taxes. Their employees can have a better quality of life because it's a lower cost of living. And so you see companies with Google and other tech companies that are expanding their Amazon and their distribution facilities. On and on and on down the list. And that is really helping us because that is further driving job growth in this area. And with that job growth, it's then also helping us with, again, additional employment and more people that are coming to the area, which again drives that opportunity for rents. When you look at the demographics of the 2 properties, the properties are 7 miles apart. And you look at one of the key figures that we look at here is there's the 1 mile area at $49,000 and then the 3 mile area at $62,000. So you've got significant income for the area. And if you kind of come back to look at this slide, you've got a 6% vacancy, 2.6% projected 12-month rental growth. So again, this is key here. We've already gone through a COVID dip. There was a little bit of a softening on rents for a couple of months right there during the COVID. But once we've kind of leveled onto a more stable ground of being able to see what things look like, you see rent growth already coming back. There's tight fundamentals there, high population, high job growth. Incomes are growing at almost 2% over this past 12 months, and it continues to be a strong occupancy market. And that's due to the demographics, it's due to the job growth, it's due to what's going on in that area with respect to the continued growth of the area. there's no doubt, again, you look at people leaving New York coming down here. You've got people from California. I mean, it is really incredible to see what's going on. And then at Britton Village, same thing. The demographics, you look at what's going on there. The average household income within 1 mile is 47,000 and within 3 miles, 54,000. So it continues to show and demonstrate that it is a robust area. And then on top of that, you've got top rated schools in the area: Jenkins Elementary School, Gwinnett Online Charter School, and then Gerard Preparatory School. Also walking distance to Rhodes Jordan Park, and then just a short 3.5 miles to Northside Hospital. And then again, close proximity to the Gwinnett County Airport, and again, not far from the International Airport as well there in Atlanta. So when we take a look at the specifics of the transaction, and we are purchasing the property for $15.93 million, that's $106,200 per door. The current loan that we have with the Fannie Mae loan is $13,476,000. Interest rate, and we'll talk about this as we dive into the underwriting a bit more, but the interest rate that we have quoted right now in our application is 3.32, but just as a little bit of a conservative buffer, we add another 20 basis points. But again, I think given the Fed's indication that rates are going to remain low for years and as much capital is flowing into this marketplace, I believe that we'll probably end up being at 3.32, but we just add that little buffer there. It is 2 years interest only on a 30-year amortization afterwards, and then we have a 2% acquisition cost. Our overall equity investment is $5.25 million, and then our total improvement costs are $917,000. So again, just taking a look at the breakdown here for the properties and taking a look at what they look like. We've got 82 units at the Carolina, built in the 70s. Again, 98% occupancy. This is so critical because what that means is we've got positive cash flow on day one. And that's key so that we don't have to go through as much of a difficulty right out of the gate, so to speak. In taking a look at the property, you see that this is a quality asset, well-maintained, good condition. The previous ownership had just spent significant money in exterior CapEx, but the majority of the interiors are in a classic condition, which gives us the opportunity to make these improvements to really bring the finishes up to a high level with the new cabinet faces, backsplash, those kind of things that really going to give the opportunity for us to maximize the rents here. And we'll explain every detail of the renovation process. Looking at the floor plans, we have amazing floor plans, good flow, good bedroom size, both for the 2-bedroom, 1-bath garden style and then the 2-bedroom, 1.5 townhome style. So again, very attractive floor plans for the marketplace as well. The execution plan for both properties, we are going to upgrade all the interiors. We have a full upgrade to the 81 units, including new appliances, flooring, countertops, hardware, backsplash, all of these items that are going to be taking place on the interiors so that you have a brand new 2000s high quality unit finish. On the exteriors, we've got lush landscaping, a grilling area with pergola, a bark park for the dogs, playground, and then a new leasing office that we're building out as well. Complete all the work and then look at selling and exiting the property in 48 months. So taking a look at the breakdown on the renovation strategy, we've got on the exterior, we've got $223,000, landscaping, grilling area, pergola, playground, bark park, the leasing office. There's also some things we'll cover under due diligence that we picked up for foundation that needs to be repaired for about $80,000, some plumbing, and about $10,000 in roof. And then on the interiors, again, with all new interiors, we're running about $243,000 for a total of $466,000 that's going to be spent to really just transform the asset. It's going to take it from the condition that it's in now, which you saw, to really just another level and bring that attraction to compete with some of the other properties that we'll cover. Britton Village, again, beautiful property. You look at some of the floor plans, even one of the floor plans has a fireplace, kind of vaulted ceilings, open, airy feel to it. Again, very attractive for the marketplace. You look at the small villa, 2-bedroom, 2-bath with the fireplace. We've got the garden style. Again, you've got patios on 2 of the options here with the 3-bedroom, 2-bath also having a patio. Also, again, a very attractive feature for the marketplace. The property execution plan, Britton Village, again, same focus that we're going to come in, upgrade all 68 units, new countertops, kitchen backsplash, cabinet upgrades, new appliances, new vinyl plank flooring, lighting packages, hardware. It really is going to bring it to compete with these other properties. And what we're ending up doing is we're offering a better quality finish or a new quality finish at anywhere from $150 to $300 cheaper in terms of what you can get for the money. Additionally, on the exterior here, doing the landscaping, a grilling area, pergola, playground as well, and then completing the work and then looking to sell, and the exit time frame is going to be 48 months. So again, when we look at the actual numbers here for the Britton Village, the exterior upgrades, about $111,000 with lighting, pergola, playground, landscaping, some of the renovation work also that needs to be done with the plumbing and taking care of that. Again, the items that we focused on in the due diligence. The interior upgrades, new countertops, backsplash, cabinet upgrades, new appliances, plank flooring, lighting packages, $340,000, all total coming in at $451,600. So we're going to dive in here and get a little bit deeper in the underwriting of everything. Now, again, I know some of the folks that you've already invested with us, and you may say, hey, Randy, I've seen enough. You can just go right to the pcpre.net/13. That's a sign up page where you can go ahead, fill in your name, fill in the soft commitment interest level you have. If there's any questions that you have, you can still acknowledge those questions in there, and we'll follow up with you on that tomorrow, in addition to providing you the information to secure your spot. So let's go in and we're going to dive into the actual property data in the underwriting now. And again, I want to acknowledge to some of the folks here on the Sumrock investment team. You're going to be familiar with this. I want to acknowledge to you that this is a reviewed property and or approved through the Sumrock process. And I know that that is for some of you who are watching, but also others of you, many of you, of course, are not familiar with that. But just so you understand, Sumrock is an investment group, and they have a particular process of reviewing and approving a property before it's able to be talked about. And so I'm just acknowledging that for those that are part of that group. But again, as we dive into the information, let's take a look at this. So we have the purchase price at $15,930. We have our financed rehab at $915,000. We have 150 units between the two properties. It is $106,000, $200 per door. And what we have are tracking for our financing is right about 78%, $13,096,000, 2 years interest only, 30-year amortization after that. Again, our interest rate, we put that 20 basis point bump in there just as a little bit more of a conservative estimate. So again, we're tracking for a total return of 92% over a 5-year hold and just under 11% cash on cash. But again, assuming that we get that lower rate of 3.32 locked in that we already have on the application, that's going to bump that return to be a hair over 11% on the cash on cash. And then we have the closing cost as well as the working capital, and then the lender upfront reserves and acquisition cost for the $1 million, $9,000, for a total equity of just about 5.12. And so again, we're tracking for 5.25 is the equity piece in this. Now, taking a look further here, again, the Britton Village rents we have at $1,025, $1,075, and $1,250. Our pro forma rents that have been confirmed with our management team that is renting properties in that immediate market, $1,300, $1,350, and $1,450. And then at the Carolina, we have $900, $1,100, and $1,000, depending on the unit style. And then where we are tracking for our pro forma rents there are $1,100 and $1,250. So this is really something that, again, is an incredible opportunity for us. We've got proven marketplace where we're getting those rents, or the competitors are getting those rents, and then we're coming in and offering a brand new renovated property at what's going to be a lower competitive rent. And so we'll go into that and really kind of dive into that in a minute through our comps. But for now, let's look at what this looks like over the 5-year analysis. So on our 5-year analysis, we see here's where they're at right now on their total income at 1.698 million. And we are tracking for the first year to virtually not grow the income. And I want to sit down on this for a moment. So, okay, we are taking this property where they have, let's say, for example, the rent at, 900, some of them are rented at 1,100, some at 1,000, and we're moving to a proposal of 1,100. We're renovating the unit in full, as you saw in the renovation plan, and we'll cover a little bit more details here in a minute, that it's a brand new unit. Everything's brand new. So we're proposing in here, and this is a part of an element of being conservative in our underwriting during some of this time with the COVID and the softened economy, that we're proposing that we're not going to even increase income for the first year. And we're still going to achieve the returns that we're outlining that we're going through. Now, my core belief is that based on our operations, our team, and our expertise, when we've taken a property that, let's say, was rented for 800, we've renovated it, and now we're offering it at 950, we're closing those deals all day long right now in Atlanta as we speak. So again, I have every belief that that's going to be the case here, where we will hit our pro forma rents. At the very least right now, there's about a 17% loss to lease on the current rent roll. So what that means is we're going to be able to go into existing tenants and be able to move them to more in line with the lease rate rent and be able to capture an advantage there as well. But, and again, if you look at this too here, and this is critical here, in year 2, we've only got a 4% increase. So over the next 2 years, we're talking about a very nominal or flat growth. Is that going to be realistic? No, I believe that we will achieve a greater growth than that. And what that will do is it will give us a higher return than what we're underwriting for. But why do I sit here and really camp on this? Because again, our approach is to be a conservative in our acquisitions, conservative in our underwriting, so that we're getting a great property, a great deal, and then we have the opportunity to outperform that. The other piece of this that's super critical, I want you to look here, is our reversion cap rate that we're proposing, say, in year 4 is 7%. Right now, the cap rate market in Atlanta is at about 5.5%. Now, this is a CoStar projection where the CoStar is projecting for that rate to decline down below 5.5 over the next 4 years. But out of being conservative, we've included it to be, we're buying at a 5.5 and we're selling at a 7. So that gives us a lot of room. Now, what do I think? I think that interest rates are remaining low over the near term. I think that no doubt there is billions of dollars in capital that's looking for yield. The multifamily space is the most attractive space. When you look at hotels, retail, office space, none of those have performed fantastically well during this time. And multifamily's been resilient. So there's a lot of capital coming into this space, and that's going to keep that cap rate low. So now what does that mean for us? That means for us, if we're able to sell in year 4 at a 6.5 cap, the return is even better. And so that's something that is critical for us to be able to look at and to see. Just double checking something here on the technology front. Okay, well, and with this, if we take a look at it, then we look and see, again, what the projections are for the cap rate here. Again, where we're at now at 5.5, they're projecting, because of the items that I said, for that cap rate to go down. So I believe that we're going to have a greater result than that. Now, take a look at where they're at with their current expenses. Contract services, we're bumping those up a little bit. Utilities, we're implementing low flow green savings so that we're saving money in water cost. Our repairs and maintenance are remaining about the same. This is key too, that when we're going through a property and we are working through that property and renovating all the interiors, that reduces our make ready and maintenance cost over the first 2 years. And then it also lowers the cost over the next 2 years because we've already renovated everything. And so now when we go to do a turn, it's a much less costly endeavor. Now, payroll, we're able to significantly save on payroll because of our management team that's in place. We'll be able to have a manager in place at the Carolina with a part-time leasing staff that helps to cover for the Britton Village, and then also our full-time maintenance person, and then a part-time maintenance tech as support, because our management team, we have other properties in the area that are being managed. Again, general administration cost, pretty standard there. Our marketing cost at $9,000, insurance, been checked with our insurance provider, and then property taxes, we've moved those up in line with what our expectation is based on the purchase price, and then our management fee. So again, you see that we're accounting for the expenses realistically. So when we're purchasing a property, we're leaving no stone unturned. So, and we'll go into that in just a second, but let's look at what the breakdown is on this in terms of the investment. So we have the sponsor and passive returns. The sponsorship group is at 20%. The equity investment is at 80% ownership. We have a 1.5% asset management fee and overseeing the management of it. Now, this is something too that I want to kind of circle back on when we look at this 5-year. So you're investing $100,000. I'll just use easy round numbers. That makes it beneficial for all of us, right? So because we're putting roughly $700,000 in as reserves with the lender, at the end of 6 months, we're eligible based on performance at a 125 debt coverage ratio to get that money back at the 9-month mark. So you're putting in $100,000 in the investment, and you can see here where we have roughly $700,000 coming back to the investors in that first year. So, and again, that's about 13% of the total equity or capital that's going into this deal. So think about this for a moment. You're putting in $100,000, you have your interest in shares for that $100,000. And at the end of year one, you're getting, besides whatever cash flow distributions that we have, you're getting $13,000 of capital that comes back. So now your real investment in it is only $87,000, but you still have the full ownership interest of what was your initial $100,000 investment. So again, very significant. And then you look at what is the projected cash returns over that hold period: 7.5%, 8.8, 10.39 for a total of 10.84 over that 5-year hold period, and then a projected IRR of just under 17%. Now again, if we get the loan rate at 3.32, that's going to boost that return. And if we have the back end cap rate where we sell for more than the 7% in year 4, that's going to boost our sales proceeds as well. But again, we don't have to have those things happen to come into play to get the kind of returns that we're already talking about. So again, that really does help make for an incredible investment. And then you say, well, how are you going to hit that number for the, $21 million? It is, or $20 million rather. It is taking a look at what does those performers look like in the end of that 3rd year. So by the end of the 3rd year, we're now at, a total of $2.4 million in income. Total expenses are $791,000. We've got, taxes, insurance, utilities. Bottom line net operating income is $1.6 million. And then cash on cash is a 10.86%. And the projected annual cash flow, $555,000. So again, what we're doing with this property is really taking it just to the next level by improving it and making it just a better grade asset. Again, it's an A-class area or A+ area, and it is a B- asset. And so we're really upgrading the quality of this to attract better paying tenants. And again, we have a lot of initiatives for our tenants. And that's something that we want to, share with you as well, where we have a focus where we do a tenant improvement, both with financial education, spiritual enrichment, kind of back to school drives for the kids. And what that does is it fosters greater community and just builds greater stickiness with our tenants. Plus, we're also focused on really improving the lives of the tenants there. So now again, I know some of you may say, hey, Randy, I really love it. I want to jump in and I want to secure my spot. All you have to do is just go to the pcpre.net/13, and there's the sign up page right there. Any questions that you have, you can put those in and we'll also answer those for you. Okay, let's look at the actual breakdown here for the Carolina apartment. So on the interiors, we've got $243,000, $81,000 is allocated for the full rehab. Exteriors, we've got the landscaping, gutters, downspouts, miscellaneous CapEx for a total of $61,000. The amenities area, we've got the picnic, barbecue area, pergola, playground, office, dog park or bark park for a total of $55,000. During due diligence, we did find some issues, and this is a point I want to stick for a moment on here. When we go into these properties, we leave no stone unturned. We walk every single unit. We have a clear breakdown of what's going on with every property, apartment, every condition of the unit, what it's going to take to bring it to the level that we need it to be to rent for what we needed to rent for. We bring our contractor out to check all the foundations of the building. We bring our roofing contractors out to check the conditions of the roof. We bring our plumber out there to snake all the main drain lines to ensure that there's no blockages or broken pipes. And then we also bring, our electrician out so that we can take a look at and ensure that all the electrical is working properly. So during this time, we found in the due diligence some minor roof repairs that needed to be done. The overall given condition of the roofs were in great condition with like a projected 7-year lifespan on them. The foundations is where there had been some repairs to a few buildings there that needed to be addressed. And so we got $82,000 allocated to that. And then we did find some issues with the plumbing with roots and some snake out and, clean outs that need to be installed. And again, the reason we put those clean outs in as well is because that helps us to save money. If you have a backup, you can access it through the clean out and it saves from that potentially backing up and damaging a unit. And as a result, we were able to get the concession of roughly $120,000 to make up for these due diligence. And so why is that important for you? It's important for you because during the hold period of our 4 years, we've got everything covered, right? There's no oh crap moment where we didn't know that this was wrong with the foundation or we didn't know that such was going on with the roof. And so that's so important to be diligent in it. And we also know by the condition of the interiors that we're on track for being able to actually get the renovations done for the cost that we're proposing. Now, taking a look at Britton Village, again, we've got 68 units, full upgrades, about $340,000. Same thing, brushed nickel, tile backsplash, low-faux, cabinet faces, black appliances, plank flooring, faux granite, lighting packages. When you see these pictures of the done property, I mean, it's just transformative night and day. And so praise the Lord, you're going to be a part of this thing and you see the results. You're like, wow, this is amazing. Again, exteriors, we're doing heavy landscaping, gutters, downspouts. We probably not going to spend that much money on it. But again, we allocate that just so that we have that. And then again, miscellaneous CapEx at $20,000. The amenities, picnic, barbecue area, pergola, playground. And then again, as part of our due diligence, we found that the plumbing, again, we had a couple of not breaks in the lines, but some bellies and some roots. And so again, same thing also with a few clean outs that needed to be installed, $15,600. So we've got all these things addressed. Now, we'll talk about just for a moment here with the amenities. What we try to do is to look at bringing better quality of life, given the asset that we have, providing things that are going to be of value, right? So the truth of the matter is, and we'll look at this with some of the competitors, and we, own and operate almost 1,100 apartments. Our management team oversees 9,000. And so the truth is 80% of the people don't use the amenities like the pool or a fitness center. They don't do. They go to the UFit or Lifestyles or whatever their gym is. They don't go to the pool. They pull up in their car, park, and then walk in their unit. That's the typical of most people. Now, again, what we do is include these because some of the people use them. Yes, they do. But moreover, when people are looking at it, when we're marketing the property, then they see these different amenities that are available. The playground, if they have children, and again, because we have 2 and 3 bedroom units, they will use that with smaller kids. So again, all of the things we do are very strategic and very thought through, right? We're not leaving anything just to chance or happenstance. So let's talk about the competing properties for the Carolina. So if you take a look at where we're at here at the Carolina, we're tracking for $1,100 and $1,250 on the rent. You've got Sugar Mill, where they're at $1,499 on their 2 bedroom, and then their 3 bedroom is $1,512. The Park at $980, their 2 bedroom is $1,245, and then $1,670, and good Lord, 3-2 at $2,400. Like I said, there is some incredibly priced properties in this area. And then we look at the Sink at 10 Oaks, Their 2-bedroom is $1,300, and then their 2.5 is $1,445. Again, the Holland Park is $1,230 and $1,405. And we'll take a look at some of them with respect to the other properties, and then also look at Britton Village. So Britton Village, we've got our tracking for $1,250, $1,350, and $1,450. Cortland at Duluth, they're at $1,300 and $1,568. The villas at Duluth are $1,350 and $1,475 for their 4-bedroom. The Veranda is at $1,600 and $1,466. The Crest at Sugarloaf, $1,700 and $2,500. So again, off the chain in terms of what rents are with respect to the competitors that we're going up against. So let's go through and we'll look at that. So we've got the Carolina, again, 32 units is the 2-bedroom, 1-bath, 50 units at the 2-bedroom, 1.5. Here is the Sugar Mill property. And so they're tracking for $1,499 and $1,500, right? We have $1,100 and $1,250. So we've got a delta there of, good Lord, you know, $400 difference on our 2-1 and $250 difference, right? That makes a huge difference, especially in this marketplace right now. This is the time to be in this asset. This is why we were very strategic in acquiring this, because when you have a softening economy, people still want to be in a great area, but they may not want to pay the $1,500 rent. So they're looking for a great apartment, but if they can save $300 a month, they're going to make that decision. Park 980, again, you've got their 2-bedroom, 2-bath, $1,600. Ours is $1,250. You've got the 3-bedroom, 2-bath at $2,400. You'll see ours at Britton Village is substantially lower than that. You've got the Sink at 10 Oaks. Their 2-bedroom is $1,300, and their 2-bedroom, 2.5-bath is $1,450. So a half bath, it's a townhome. Ours is a townhome, and it is $200 cheaper. I mean, $200 may not be a tremendous amount for you or I, but to somebody renting an apartment, it is a world of difference. That pays for their insurance on their cars. And in this environment, people are looking for that kind of quality property at a lower price, and that's going to benefit and serve us well. Again, Britton Village, we'll move through this so that we can get through all the information and then address and answer any questions as well. Let's see here. Again, Cortland Duluth, they have $1,360 and $1,598, and we are at $1,350 and $1,450. So again, on par with where they are at, and then even additional savings compared to the 3-bedroom versus their 2-bedroom, 3-bath. Again, the villas at Duluth, all classic units. I mean, classic units, and ours are upgraded and brand new, and we are at the same price and cheaper to what the villas at Duluth are. And then also the Veranda is $1,519 and $1,745 versus our 3-bedroom at $1,450. Now that does include utilities at $1,700, but again, now with all of our properties, we're implementing a master cable strategy as well, so that we're able to offer full cable internet and for about $89 to our residents. So again, going to be a great thing. But what you can see here is that with these properties, they are in a position where we are competing head to head with these properties and providing a better quality of living in terms of price. And so that's something that's significant. So again, let me just take a look and see what questions maybe we have. Okay. Yeah, so there's a question that comes in here. Is there cash returns for the first year? Yes, it would be projecting for that, so that we would expect that there are returns for the first year and then for subsequent years through the life of the property. Let's see here. All right. Another question, what is the length of time frame? The length of time frame is 4 years. So again, if you are, let's say, if you're looking at investing and you say, well, I'm probably going to need this money in 3 years, this is really not the asset for you. Now, we have other properties that are maybe shorter in time frame, but this is a higher return vehicle, and it just takes a bit of time on 150 units. Realistically, we work through that renovation plan that we outlined here, and that is probably going to take 18 months by normal experience. So we usually track to plan for 24 months on a property of this size, because what we're doing is we're doing the renovations on the turn. So we're, somebody that's at $900, we're moving their rent to $1,000. Some of those people will not take it. Then we renovate their unit and offer that at the market at $1,100. So it's a very strategic strategy that goes to maximizing cash flow and income in year one and in subsequent years. And it takes us about 2 years to work through the property in full to renovate all the units. And then we work through optimizing the T12 and the cash flow in that following year. And then the fourth year, we're prepping the property to sell. And then even at that time, prior to exiting, we also begin testing out some additional upgrades to interior units to, really make a super elite type unit, and then offering that to the market for a little bit of a rent bump. And so that gives us just even more people to sell to. So again, another question is on depreciation, and we're going to be talking about that in just a minute, so I'll cover that. But let me talk about the COVID preparedness too. So in this, we have a guaranteed income in the contract through closing that they have to maintain a minimum of $134,000. So what that means is that with the moratorium on eviction or whatnot, we've got that built into the contract so that you have to keep the performance there. So when we take over and close this property in November, that we're not just taking over a bunch of problems. This property's operating well, we're collecting rent, and we're able to move forward immediately with our plan. The other thing that's exciting is the pricing relative to the targeted sales comps. And we'll go through and take a look at some of these comps. So we've got the Carolina, again, what this is that we're buying it at $106,200 per door. The Legacy at Norcross just sold last year at $113,000 per door. The Fairway sold 3 years ago at $115,000 a door, and most recently the Avana on Breckenridge sold at $130,000 a door. So this is important because, again, when we're looking at a property, not only do we look at it to see what the rent comps are, but we look to see, do we have proven assets in the area that have sold for what our exit price is? And the answer to that is yes. We've got properties that have sold for the $130,000 mark that we're tracking for. And if you look at Britton Village, again, we're paying $106,200 a door. The villas at Duluth sold just recently last year at $133,000 a door. The Ashford Meadows property sold at $125,000 a door. Good Lord, back in 2016 in this area, right? And then most recently, the Avana again sold at $130,000 a door. So we've got properties that have sold at $125,000, $130,000, $133,000 a door. What that gives us is it's proven concept that if we go in, methodically improve the property by renovating the units, bringing in just another step higher quality of tenant, getting the rents that we know are able to be obtained by what's being born in the marketplace, that then we have an automatic pathway to the value of our property and our exit. So just so you know too, for us as a company, and because of the fact that I've been in the investment space since 2003, and we have that track record of 17 years of double-digit investor returns, we're not buying something that doesn't have all of the pieces to it. And what I mean by that is we're never the pioneer, we're always the settler. What does that mean? It's like when I go in and purchase this asset, I want to see the sub-market rent comps that we've already gone through that show me without fail and without equivocation, I can get the rent if I do the work, right? That's key. You got to do the work. That's not a problem. We have the team and the staff and the ability to do it, as you saw as well earlier. The other thing is I don't want to be a pioneer with being like, I'm the first guy to sell for $133,000 a door. I want to see that in that marketplace, there's other assets that have already sold. Now, again, they're nicer, they're producing more income, but they're tracking for who I'm going to become. And it's a proven concept. That's key. And so we have that here with this asset, and that is what's going to yield a fantastic result. So again, just as a recap here, as we get ready to kind of wind down, our total project return is tracking for above 17%. Our cash on cash, 11%. In total return, 93% when we factor in that bump that we'll get from the loan. The K1 depreciation, and this is key, we're tracking for a $100,000 investment, $56,500 the first year, and a timeline of 48 months. So our minimum investment is 100,000. Our max is 1.2 million. And I want to go over what our accounting and engineering firm has already done in terms of how did they come to the depreciation and cost segregation study. So they've already looked at the property. Their standard basis of what they find is about a 31% basis. And so on that level, what that means is that on those findings, the year one depreciation amount would be $67,905. If we held the property over the subsequent 6 years, you would pick up another $30,000 of depreciation. So again, what that is, it's about $5,000 more dollars a year in depreciation beyond that $67,000 that came to you. So what does that mean? It means the first year you get 67, and then over the next, say, 3 years during that 4-year hold period, you'd get another 15,000. So again, good Lord, that would put you, 67 plus 15. It's putting you up into the, 82,000 range of depreciation on a $100,000 investment. And don't forget this, the first year you're getting back roughly 13,000 from the capital that's coming back to you. Now, they did also provide a 20% cost basis analysis, which would put you at 46,000. And then over again, that same additional 30,000 coming in over the ensuing 6 years, or about roughly 5,000 a year. So again, that brings you up to about 61,000 over the 4-year hold period. So what we did is we split the two. Now, talking with them, the guy that runs the company, he's like, Randy, we normally hit this 31 mark. So this is what it would be. On the low side, it would be this. So we decided for this presentation and for your decision-making, we're going to split the two. He was fairly confident that he says, Randy, and again, normally we go there, this is what we see, so this is what we expect. So again, that is super powerful in meaning that what it can do for you on the taxes. So let's just look at, just roughly speaking, you invest 200,000, first year cash flow, you get 14,000, first year depreciation on your K1 is $113,000 loss. It's like, whoa, that's the power of the cost segregation. That's the power of real estate. And so what that means is that 113,000 offsets the tax liability for the 14,000 that you got for it. If you don't use the depreciation elsewhere through your eligibility, that money rolls over and can then offset the next year's taxes. And that's in year 2, year 3, year 4. So really you're getting all this cash flow, and because of the depreciation, you haven't had to pay taxes on it. And then when the property's sold, those monies are treated at capital gains, which often is going to be a rate substantially less than the 33, 36, or 39% that you are already paying. Now, that being said, I definitely say and recommend you need to consult with your CPA to see exactly how you are able to use the depreciation for your specific tax benefits. So again, this is going to be, no doubt, it's a limited opportunity. As I said, in the last growth project that we did last December, we had an investor that put $1 million in. Right now, we've got a large group. They've already made a soft commitment for $2 million, another group at $1 million. They still are going through some of the processes there with their own internal things. So again, assuming that goes through, that's $3 million out of the 5.2 million. So again, with this kind of opportunity, it does go quicker. And so I want to encourage you to take action. Fill out right now. You can go there to the pcpre.net/13. Just fill in Carolina and Britton. You can put in your name, phone number, and email. The approximate contribution, again, it can be more or less. You can put it in and say, here's what I want to do. And then also the additional questions or comments that you have. You may have some questions, hey, I want to put in 250,000 and here's a question I have. Some people will ask, and I saw another question come in, can I use my IRA? Absolutely. We have, multiple custodians that we work with that are self-directed IRAs. Typically 25 to 30% of all the money that comes in the form of qualified money. And so absolutely you can use your IRA. Our skilled team will work with you to help get the paperwork completed. We have an investor relations person, Clyde, who will be in contact with you. He'll, work with you in getting the paperwork set up. He'll work with the vendor, whether it's Quest or one of the other providers, and he will help facilitate that. So to make your life easy, he'll get that done. So timeline, you go ahead, fill this out this evening, make the indication, and then with that, we'll be in touch tomorrow to answer any questions, and then also facilitate getting the paperwork to you with respect to the PPM and other accredited investor documents. This is an investment opportunity, of course, for accredited investors. It's a 506c opportunity, and so we want to acknowledge that as well. And again, I just look forward to having you be a part of what we're doing, and looking forward to, let me just see if any more questions come in. All right, we do not have any more. So again, I want to thank you so much for taking this time and joining together with us. And, I want to encourage you right now, secure your spot today. Go to the sign up page, pcpre.net/13, and secure your spot. This is going to be an amazing project. It's going to be another winner in the Prosperity Capital Partners portfolio. And I look forward to having you become part of the family and investing with us. And I mean, we've got investors that have been invested with us for 17 years now, and it's changed their life. And so I look forward to that same thing, being able to be here for you and your family as well. Thank you so much. I appreciate the opportunity to come and spend this time together with you. And I just wish God's blessing for you this week, and I look forward to speaking with you. Thank you so much. God bless. Have a blessed evening.